As of 10:40 a.m. Eastern Time on November 5, 2025, Plug Power, ticker PLUG, is trading at $2.55 per share, showing a modest gain on the day of about 1.2%. The stock is fluctuating in a tight intraday range between $2.45 and $2.59 on what is already significant volume of over 21 million shares. Now, while many investors might see this small green day as a stabilization, what's happening beneath the surface is far more critical. This price action isn't a sign of new conviction. It's the market bracing for impact. We are just days away from the company's third-quarter earnings report, scheduled for November 10th, and for a company like Plug Power, this single event could fundamentally alter its trajectory. Analysts are already setting a tense stage, forecasting a loss of around 13 cents per share. While that's a significant improvement from the loss reported this time last year, the consensus for revenue is what's truly concerning, an estimate of around $173.5 million, which would represent virtually zero or even slightly negative year-over-year growth. For a company priced on the narrative of explosive expansion, flatlining revenue is a signal that triggers alarms. The common belief, the narrative that has captivated so many investors, is that Plug Power is the chosen one for the green hydrogen economy. You've all seen the headlines. This is the company that secured a landmark $1.66 billion loan guarantee from the Department of Energy earlier this year to build out its hydrogen production network. This is the company announcing massive-scale projects like the recent delivery of its 10-megawatt electrolyzer system for Galp's 100-megawatt refinery project in Portugal. They've announced a deal for up to 2 gigawatts of electrolyzers for a sustainable aviation fuel project in Uzbekistan and another partnership in Nevada. The expectation is that Plug is building the entire ecosystem, from the electrolyzers that make the fuel to the hydrogen-powered forklifts used by giants like Walmart and Amazon. It looks like an unstoppable force backed by government policy and corporate demand for decarbonization. But the reality, the one that the market is grappling with right now, is that Plug Power is in a desperate race against time, and its opponent is its own balance sheet. The market is finally waking up to the fact that the $1.66 billion DOE loan isn't a blank check to fund operations. It's a project-specific financing tool. The core business, as of the last report, is still hemorrhaging cash. In the second quarter alone, the company burned through approximately $230 million, leaving it with a cash and equivalents balance of just over $140 million. This is the brutal disconnect at the heart of this stock. You have a multi-billion-dollar vision for the future, but a quarterly cash burn rate that exceeds the cash on hand. This is why the stock has been so volatile, collapsing over 33% in the last month alone, even as these positive project announcements were being made. The market is no longer just trading the dream, it's pricing in the severe risk of financial distress. Investors are realizing that these long-term projects, while impressive, do not solve the immediate existential problem of funding the company's day-to-day losses. This disconnect is precisely what has attracted an enormous amount of short seller activity. This isn't a fringe theory. The data is public. As of the last reporting period in mid-October, Plug Power had over 331 million shares sold short. While that represents a massive bet against the company, the days-to-cover ratio is quite low, sitting around 1.5. This low number means that given the stock's extremely high average trading volume of over 200 million shares a day, shorts could theoretically cover their positions relatively quickly. This isn't the classic setup for a GME-style low-float squeeze. Instead, this is a deep, fundamental bet. The short thesis is brutally simple. Plug Power's business model is fundamentally unprofitable at its current scale, and the company will be forced to dilute its shareholders into oblivion to survive. Shorts are not betting against the idea of hydrogen. They are betting that Plug will run out of money before it can ever make that idea profitable. They see the negative gross margins from the second quarter, where it cost the company more to make and deliver its products than it earned selling them, as proof that the model is broken. They see the $140 million in cash versus the $230 million in quarterly burn and believe a massive, value-destroying equity offering is not a question of if, but when. For investors trying to navigate this, it's crucial to understand how to track this battle. You can find the official short interest data published twice a month on the NASDAQ website. But the more timely, actionable metric to watch is the borrow fee rate. This is the interest rate, or rent, that short sellers must pay to borrow the shares they need to sell. When this rate, often available through brokerage platforms, starts to spike, it signifies that the supply of shares available to borrow is drying up. That is a real-time indicator of increasing short pressure and can be a precursor to a volatile move if the shorts get caught in a wave of good news. The risk for retail investors here is enormous. Chasing a potential short squeeze in a company with such severe liquidity concerns is a high-stakes gamble. The shorts could be right, and any rally could be an opportunity for them to double down or for the company to issue new shares, capping the upside instantly. What is your opinion on this heavy short position? Do you believe it's smart money correctly identifying the extreme financial risk? Or do you think it's a crowded trade that's ignoring the power of the DOE backing? So, what does Plug Power actually do? For years, its core business was selling hydrogen fuel cell systems, primarily the GenDrive units, to power material handling equipment like forklifts. This was its razor business. The long-term plan was then to sell the blades, the green hydrogen fuel itself, produced by their own electrolyzers and delivered through their Gen Fuel network. This is the end-to-end solution they talk about. The company has expanded aggressively into stationary power with its GenSure units, and most importantly, into the manufacturing of the electrolyzers themselves, which are the machines that use electricity to split water into hydrogen and oxygen. This electrolyzer business is the key to the whole green hydrogen thesis and a focus of the big projects in Portugal and Uzbekistan. The company is trying to pivot from just a forklift power provider to the central equipment supplier for the entire global hydrogen build-out. The problem is that scaling up this manufacturing is incredibly capital-intensive, and it's happening at the same time its legacy business is still struggling with profitability, creating a perfect storm of cash consumption. This brings us back to the immediate future, the November 10th earnings call. This report will be less about the 21% year-over-year revenue they posted in Q2, more about raw survival. The headline revenue and earnings per share numbers will almost be secondary. The market will be laser-focused on two things, the balance sheet and the gross margin. First, what is the exact cash and equivalents number as of September 30th, and what was the cash burn for the third quarter? Any sign that the burn rate is accelerating or that the cash position is more precarious than feared could send the stock into a tailspin. Second, what is the gross margin? The company cannot survive if it continues to post gross losses. Management has guided for gross neutrality by the end of the year, a promise that the market is deeply skeptical of. They must show a clear, undeniable path to profitability on the products they are actually selling today. The future outlook, therefore, is a study of extremes. The bullish case, championed by firms like H.C. Wainwright with their outlier $7 price target, is that the company is at its darkest before the dawn. The bulls believe the DOE loan and the major project announcements provide the bridge to scale up. They argue that as Plug's own hydrogen production plants in places like Georgia and Tennessee ramp up, their fuel costs will plummet, fixing the margin issues, and proving the razor and blade model works. They see the recent stock collapse from over $4.50 to $2.50 as a massive overreaction, a prime buying opportunity before the earnings reports start to reflect this scaled-up reality. The bearish case is that the company is a house of cards. They see a history of broken promises, missed targets, and relentless shareholder dilution. They believe the DOE loan is a distraction from the failing core business, and that the new projects are too far in the future to save the company from its immediate liquidity crisis. Comment below what you believe is the most critical number Plug Power needs to report on November 10th. Is it the total revenue, the earnings per share loss, or the cash on hand at the end of the quarter? In the end, the story of Plug Power is the ultimate embodiment of expectation